Greetings, tēnā koutou katoa, Bulavanaka, kia orana, and I want to especially, that is, have a happy Sign Language Week. Welcome to the Reserve Bank and to our monetary policy statement. I'm Adrian Orr. I'm the Governor of the Reserve Bank, and I am very, very privileged and proud to have the responsibility for the role that we've got. I want to introduce Dr. John McDermott and Mr. Jeff Bascand. They are my Governor colleagues and have been highly involved in the production and decision making that we've made here today. I would have to say it's been the easiest decision that we've had to make, or I've had to make at least, for 11 and a half years. Easy in the sense that we're in a good spot. We can keep the OCR where it is for a considerable period of time. The hard part about it is what to do next and when. In other words, the risks are balanced. I was told a long time ago that it's very hard to work out what to do next with monetary policy. It means you're probably in a good place to start with, and so I believe that's where we are today. It was a unanimous decision actually across our monetary policy committee group, and I would also like to thank the two external advisors. This time around it was their first time. It was William Rolleston from the Deep South and Susan Patterson from Tamaki Makaurau. So it was a very good effort from them all. So, for the record, the official cash rate will remain at 1.75% for some time to come, and the direction of our next move is equally balanced, up or down. Of course, only time and events will tell the direction and timing of that. Economic growth and employment in New Zealand remain robust, near their sustainable levels. However, consumer price inflation remains below the 2% midpoint of our target. And this is due in part to low import prices, the recent reduction in the food price inflation, and of course the subdued wage pressure that remains in the country to date. The recent growth in demand has been delivered by an unprecedented increase in employment. The number of willing workers continues to rise, and this is especially with female and older workers wanting to participate. Likewise, net immigration has added to the supply of labour and also the demand for goods, services and accommodation in New Zealand. Looking ahead, global economic growth is forecast to continue supporting demand for New Zealand's products and services. Global inflation pressures are also expected to rise. They are rising, but we anticipate they will be contained. Central banks are doing their job elsewhere. At home, ongoing spending and investment by both households and government is expected to support economic growth and employment demand. Business investment should also increase, given the rising capacity pressures. These emerging capacity constraints are projected to see New Zealand's consumer price inflation gradually rise to the 2% midpoint of our target range. However, to best ensure this outcome, we expect to keep the OCR at this expansionary level for a considerable period of time. This is the best contribution we believe we can make at this point to maximising sustainable employment and maintaining low and stable inflation. Me taki ma'ata, and I am open to questions.
Governor, you've stressed that the risks are balanced to the outlook at the top of your statement. Just want to ask you directly, are you leaving the door open to a rate cut? And if so, what would need to happen to get you there?
Yes, the door is open to both a rate cut and a rate rise, so that's what we mean by balanced. The risks are relatively balanced, and we go to considerable pains to outline how they are balanced in our monetary policy statement. A rate cut, some of the key risks there would be international growth faltering, or more importantly, international financial conditions tightening. That could happen through rising long-term interest rates and that feeding through into New Zealand interest rates. Likewise, credit is highly constrained, and so that would be a double header for people who are relying on borrowing to continue their consumption path. Immigration. You know, we can only control one side of that variable. It's a risk on both sides. And probably the most perplexing thing for us really has been the very, I suppose, suppressed wage inflation and the way in which price setting is happening. And if that continues to be backward-looking and based on the past low inflation, then it will take longer for us to reach our midpoint. And so those are some of the environments. John, Jeff, have I missed anything?
No, but perhaps we can add, in thinking about that, we illustrated one of the possibilities, which was tighter financial conditions in the statement, and it's there in figure 2.9. So there's a range of things that can happen, but the type of response is articulated in the statement.
Hi, I'm Charlotte Greenfield from Reuters. You've pushed back your forecast of inflation hitting 2% to Q4 2020. Could you just explain what prompted that and whether it is a bit of a concern given that's quite a way out from where we are now?
Yes, thank you. Hello, Charlotte. Yes, it is a concern, and that's why we are keeping monetary policy expansionary. We have been surprised for some time now how low actual inflation outcomes have been occurring, in part through that domestic pass-through of demand pressures or capacity pressures has been very, very light into ongoing inflation and price setting. Even though inflation expectations are well anchored at 2%, we haven't seen it actually feeding through as fast as what traditional models would have anticipated. So that's why we're staying expansionary.
Governor, you've forecast lower GDP growth and lower CPI inflation than in the previous NPSs. Isn't there an argument to cut interest rates here, given that you've still got unemployment well above 4% and you're seeing some slowing in construction and consumer spending?
Yes, I think there is an argument. Likewise, there is an argument to be raising rates. You know, this is the challenge, the balancing act that we've been having to do. So that argument was very well articulated and was part of the balancing act that we're doing today. And this is why we're sitting here saying, look, on balance, we expect to be where we are for a while. The next direction is even.
What do you think of the view that central banks need to push inflation significantly up and therefore get interest rates up so that they have more of a buffer the next time there's some sort of significant downturn?
I don't think too much of that. I think they need to just have interest rates set where it makes most sense for the current situation. I think you can double guess yourself too much. Remember, nominal interest rates are one part of the equation, real interest rates are another part, and also there are alternative methods for managing monetary policy. In fact, it's been very interesting globally. You know, some of the very large central banks have been reducing or you know, shrinking their balance sheet, and particularly in the US, after significant monetary, you know, basically helicopter money into the economies. And that's been happening with very little noise in a very stage-mannered way.
Hi, the previous governor didn't have much success at hitting the midpoint of the target. What's your view of whether your performance should be judged as on the fact that you get close to that 2%?
Our aim is always to try and maintain 2%. By the way, I'd like to just acknowledge at this point both the previous two governors, the acting one in between. I've never arrived at such a simple starting point where the economy is well balanced, employment has been very strong, inflation's been low and stable. So whether they were wisely advised by these people and incredibly smart themselves, I'd like to congratulate them on their efforts, particularly through the global financial crisis. The banking sector in New Zealand came through remarkably well relative to many of our trading partners, and I have started, you know, in what I would call a sweet spot for any governor to turn up.
Hello, Thomas from Newsroom. You've got a dual mandate now. Is it fair to assume that that's fed into what you were saying about the door being open to both a rate cut and a rate rise in the future?
Definitely. We have to take both our contribution to maximising sustainable employment as well as aiming for the midpoint of this inflation target with equal concern. And I hope the document highlights that. The challenge is that, the inflation target is a very well set single point that we can all observe. The maximum sustainable employment concept is not, and this is where we have to put a lot of judgment and balance around what we're doing. We've gone to considerable effort to highlight the many different measures of ways of getting a handle on what maximum sustainable employment is. We don't influence that. We just try to make sure that actual employment is somewhere near that level as best we can.
Emma Jolliffe from News Hub. You talk about the unprecedented rise in employment and that being down to a lot more women and over 55s joining the workforce. Do you have a theory on why that is?
Yes, the entry into the labour force is a lot easier. There is a very big different changing in the demographics of households where females can participate. Health and well-being of people is improving all of the time. Life expectancy is rising. People want to be part of the community. People also need to work, so that labour force participation sits pretty well at the top of the OECD in New Zealand, and we should be proud of that fact that people can enter the labour force and hopefully actually pick up work on the way through. The other big driver, of course, has been the net immigration, which has been again virtually at record levels as more Kiwis have stayed home, given the relative labour market strength here versus our traditional Australian valve. And a lot more people wanting to turn up and be involved in the New Zealand economy.
Nick Perry from the Associated Press. You said that you've arrived at a sweet spot thanks to your predecessors, but are there things that you want to change in the direction you're going, or things that you're going to tinker with?
Absolutely. Otherwise, where's the challenges? For me as a CEO of a very prestigious institution, some of the changes we've made very clear. We want to make sure that we are communicating very clearly out to a wider audience rather than just the half dozen retail bank economists. And so that's been some of the effort we're making. The other change, of course, is I've arrived at the time of a new PTA. And so John and his economics team have got a real challenge around understanding what is this maximum sustainable employment? How can we best contribute to it? And we've certainly gone out to New Zealand's smartest economists, and we'll be talking a lot with the labour market folk. Another big transition for us is going into a monetary policy committee decision-making structure under the recently agreed legislation. So that'll be going through Parliament, and that's about trying to make sure we go through a smooth transition into that committee structure, and that we remain as coherent and I believe as successful as the bank has been over now a few decades of maintaining low inflation.
Thanks. Just one other thing. Can you tell us how you feel about housing prices at the moment and how much that's factoring into your decision?
Yeah, so house price, or I should say household wealth held as equity in their homes, is a significant driver of consumption and behaviour in New Zealand. That is without doubt. And we have been feeling wealthier because of that rise in house prices over the last 5+ years. We've seen that tailing off, the growth rate in house prices. And, we see that as a positive thing because they have been extremely stretched relative to affordability levels, income earnings. So in one sense, for our financial stability concerns, we've been very pleased to see that market, the heat coming out of that market. Has it gone far enough yet? Not according to our projections. We expect house price inflation to continue to ease. That sits there as one of the risks on our inflation outlook, because the less they ease, the more people consume, the more capacity pressures, and hence the more work monetary policy may have to do.
Governor, where do you think maximum sustainable employment is, given Stats NZ estimates there's 330,000 people who are either unemployed or underutilised, which sounds like we're not at maximum sustainable employment?
We think we're there or thereabouts, and we've gone to a significant. Sorry, I'm looking through the document so I can point it directly to you, Bernard. There are many varied measures of employment utilisation, underemployment, unemployment, that wonderful economic term, non-accelerating inflation rate of unemployment. And, we've gone, I think it's figure C6 in our document, John and his team have carefully plotted as many of these variables as we can currently measure that give us some kind of sense of maximum sustainable employment. You can see that at the moment, the midpoint sits at about we're there, but across a very wide range of, plus or minus 1% of the midpoint of.
Well, 0 from that detrended level.
From the detrended, from the average, from the long-term average. So you can see, it gives a very clear idea. By the way, that is exactly the same for potential output, the same level of uncertainty. For a long time, the bank has driven monetary policy through a sense of demand pressure versus the potential to supply it. So it's a very similar concept, and as you're aware, that has equal uncertainty, in fact slightly wider even, measures of potential output and the output gap. So, we'll be doing a lot of work on what best tells us what drives inflation, and we will be having to learn, and we'll be having to experiment on the way through with our usual efforts.
Do you think there's a need to improve your estimates of potential output and where that level of maximum sustainable employment is, given the last 4 or 5 years the Reserve Bank has, its estimates have been below where it turned out to be?
I think there's improvement is always an ambition, without doubt. So yes is the short answer. The longer answer is I think it has done a remarkable job at being able to allow us to forecast what I would call core or domestic or non-tradables inflation. We have to remember that headline CPI inflation is at 1.1%, but simple measures of core inflation are about 1.5%. In other words, these numbers get knocked around by something we have no influence over, which is import prices, global inflation, and then putting the exchange rate on that. So the output gap measures, they are uncertain. Improvements would be very desirable, but at the same time, they've done a remarkably good job in the absence of things that work better. It's not just the measure of the output gap, by the way, or potential output, it's actually how it feeds through into inflation. And this has been one of the biggest challenges we've had. It's just that it's about how people in their minds set future prices. And at present, the best way we can model future price setting is by looking backwards. In other words, people aren't saying, hey, the midpoint's 2%, let's set our prices for the midpoint. Instead, they're saying, hey, over the last year, this consumer price thing that no one actually sees, it's only an average consumer, was at 1.1. So I'll set my prices there. So that's why we're saying be forward-looking, understand where we're aiming for, and we will continue to have expansionary policy for as long as we can. If we have to get the historical rate to 2, because you're only going to look backward, then we will keep at it. A question, John, or an answer?
No, I want to ask you a question. Just to add to that, I think it's right. Of course, we want to make improvements, but it's not just about improving the models. What goes into the models is just as important, particularly the data. And I think if you're looking down this space, we need new data, we need improved data, and we're talking to Stats New Zealand about this. And a couple of directions that I think would be useful. One is, good high-frequency payroll data would be really helpful, and in particular, information about how the labour market's flowing, exit and entries into the labour market, and job-to-job transitions would give us a way better understanding of what's going on in the labour market to pin this down. And so basically we can't do this all by ourselves. We need help from the rest of New Zealand actually to put this piece together.
Have you recommended to the government and Stats NZ that they come up with different measures, including, for example, a monthly measure of payrolls or the labour force?
We just did on national television and the media, so I think the message is loud and clear, and the government understands that. In fact, we've got an ex-chief executive of Stats New Zealand, Jeffrey.
I think it'd be a good idea.
There we go.
Yeah.
So no, it's loud and clear, and more capital would be greatly welcomed.
Hi, Jason Walls from Interest. You mentioned the fact that you were going to have a bit more open communication and not just talking to a handful of economists. Are you not concerned that this might open the door for a little bit more misinterpretation when it comes to the market?
I think our challenge is to speak in plain English, as opposed to in a high-tech scientific language around which only half a dozen people actually understand and even less are interested in. So, we do need to have a richer dialogue. We've recently completed a survey around what people think of us. The journalists in this room said not much because we haven't been very open, according to their perceptions, and we hear that loud and clear. The interesting statistic I found from the survey was the vast majority of the public had no idea who we are. So, it's a good thing on Saturday at the football ground, but not necessarily a good thing if we're trying to raise financial literacy and make people think harder about all of the things that are important to us, soundness and efficiency of a financial system. I love the pictures, and Tom, he's not in the room, he's our chief drawer. We do actually hope, that's another area we hope to upgrade, Bernard, is the quality of our pictures. These were all we could get immediately off one of our kids' icons, actually. But it is exactly about that, is being able to explain the story simply. And I think that's a big challenge for us all. What is it? Sorry for the long essay, I didn't have time to write a short one. It is a real challenge for us to synthesise down what we're about and what we're looking at for a broader audience.
Thank you, Governor. Michael Crock, One News, might be one of those people in that category you were talking about just before. I'm just wondering, your comments just before about price inflation and price setting. Are you effectively telling businesses to raise prices, or at least to be proactive on that front?
I'm telling businesses to keep looking forward when they are doing business, not looking backwards. And you're looking at global inflation rising, you're looking at many capacity pressures building. Traditionally, it's about what you expect to happen, which would form your business intentions, not what just happened. So that's all I'm saying. I'm certainly not telling businesses how to run their business. One of the most interesting things, and it's a global phenomenon, it's not New Zealand specific, has been the very low level of nominal wages, despite very positive growth over the last post-GFC, which is almost a decade now, I have to stop saying that, showing my age, period, where profits and output growth have gone up considerably, but not necessarily nominal wages. And we are looking kind of towards down the end of that barrel, saying how much further can labour force participation go? How many more people can enter the labour force? So at what point is this wage pressure going to really show its head, and how is that going to be passed through to consumer price inflation? Can businesses actually pass on these costs, or is it going to be further margin compression? So that's where it's at. You've seen margin compression in some industries quite significantly. The costs have not been able to be passed on because of fixed contracts. I don't think they'll be doing that again.
If I could ask one more question, please. You also talk about the decline in net migration. How much has that accounted for our recent growth in recent times, and then what do you expect it to account for in the future?
Proportions of growth, people?
Population growth's been a strong factor in the economy's development over the last 3-4 years. So yes, it has been a significant factor, and we still think it will be. We've got it slowing from really record rates that we've had, but it's still contributing positively to demand for housing, demand for other goods and services. And we don't see a dramatic turnaround. We just see that the forces that have been at work is that gradually a few more New Zealanders will venture off to a better Australian labour market, things picking up.
and some probably thinning out a little bit of some of the inflows as well. So yeah, it's a big part of the story and continues to be.
Yeah, I mean, I refer you to, I think it's in one of the cartoons, but it's also in figure 3.5 and 3.6 in the document, and that shows the contributions to what we call our potential output, our ability to supply, how business investment or capital is added to it, and then how the labour force is added to it. And you can see that labour has been a good 2/3 of the potential output growth that we've seen because of both natural population growth, increased participation and net migration. And then looking forward, you know, that all three of those, or the two bits with the labour are easing, but still positive.
Just wondering if you could put that in like simple GDP terms at all?
1.5.
No, I can't off the top of my head, sorry.
It's about 1.5 for the last year or so. Percent growth.
Growth. I was struggling to divide 3 by 2, so
yeah.
So it's 1.5, I think. Can I confirm that? Excellent.
Kia ora again. Are you relieved about the recent fall in the Kiwi, both in recent weeks as well as the 0.5% it fell this morning, and would you like to see it fall further?
Relieved would be an emotion, and I don't have an emotion over currencies, so no, I'm not relieved.
How do you, or how does the bank view the fall?
We see it, there were probably more sellers than buyers at the previous price based on the future outlook for the interest rate differentials, and that will be factored into what we have to do next time we boil up our monetary policy. To be less glib, our terms of trade have also, you know, returned to record highs. It hasn't felt like that because we all stare at Fonterra and worry about dairy milk prices, but our actual terms of trade are at a very strong level, and when you map the terms of trade against our trade-weighted exchange rate, which we have done in this document, you'll see that, you know, you can largely explain the types of levels that we've been at.
Yeah, and then with the bond market and with US Treasury yields at current levels of 3%, how do you sort of view the flow-on effects for New Zealand markets?
Yeah, we put that down as one of our key risks. You know, bond yields can rise for good reasons and for bad reasons. The good reasons is because monetary policy is renormalising globally. Interest rates are heading back to, you know, somewhere neutral, if not north of neutral, because growth is happening, inflation pressures are rising, and the world is beautiful. They can happen for bad reasons, because suddenly people think, wow, we're overly indebted and I need to put a big fat risk premium over any future borrowing. And at the moment, I think good is outweighing bad. But that is a risk we talk about in our documents around the difference between those two.
Richard Harmon, Politic. There are a number of references in here to constraints in the housing sector. What are those constraints, and what impact do you expect them to have on the aggregate number of houses built, and in particular the number of houses delivered under Kiwi Build?
Yeah, very, very good questions. It's been a real double-edged sword for us trying to work our way through this. You know, the population, you can see that demand for housing is very clear. It's the ability to supply the housing that is the challenge. And the biggest constraints is actually access to affordable land, and more importantly, affordable land that has access to the utilities that are needed. So this remains a real challenge. I don't have to explain any of this to New Zealanders. I used to just say Aucklanders, but it's pretty well across the board. So, you know, the ability to get access to the land and the resources, there is a big infrastructure challenge going on. We've woken up to that challenge, but delivering on the challenge, it remains uncertain around timing. The timing part remains very uncertain because resources are also, you know, becoming scarce. You've seen labour cost in the construction sector rising ahead of other forms of labour cost. It's just the outright supply, you know, to actually get on and do this stuff. For the Kiwi Build, we've put in there exactly what was in the half-year economic fiscal update from the Treasury's estimates. 2019, mid-2019, Chris, you know, they're on the road, they're hammering madly, So that will be, their challenge will be the pace at which they can do that, and more importantly, what are they crowding out elsewhere with regard to resources or access to land. So, we've had to factor all of those things into our forecasts.
Given the endless ability of the other 99.8% of the world to blow things off course here, is there any particular part of the international horizon that you're looking at particularly intently as the source of a potential shock at the moment?
Well, the good news about shocks is you didn't expect it, so I no doubt I'll get it wrong. But the types of risks that we are looking at was very much from what Charlotte mentioned before around a sudden ratcheting up in global financial conditions, i.e. they tighten very hard. It might be through increased volatility, equity markets getting spooked. It might be through a sense of debt limitations and much higher global nominal interest rates, risk premia. So those things can come through very quickly, and we have to make sure that our financial system is able to weather through that. And that's what we worry about a lot. Are the banks lending responsibly? Are people able to afford these mortgage rates at levels higher than currently where they are? And that's the type of work we've done with our LVR limits, trying to cool the investor market down, as well as, talking very, very forthrightly with the large lending institutions at the moment.
I might just add to that part of that vulnerability, those international financial markets, I guess what worries us is the debt levels that exist in a number of countries, and in a sense, if there's a different appraisal of those, people do get spooked by that, either in China or even the US debt levels that are getting quite high. Then you can see these things, sentiment change and market rates move quite quickly. So that's part of that underlying vulnerability. They've of course got the geopolitical and trade risks. They very, very hard to work out how you reflect those. They're on our horizon. We watch them and monitor them, but you can't really build them into any particular central scenario.
Even domestically, you've got high debt-to-income levels in New Zealand households, and you're projecting the household saving rate to remain negative throughout the forecast period. How worried are you by that as part of your sweet spot?
Concerned, that's so it's a starting sweet spot on a business cycle. Is it a starting sweet spot on the structural makeup of New Zealand's financial system as a whole? We've got our other mandate, sound and efficient financial system, and we've spoken very vocally around high levels of household debt, and particularly concentrated levels of household debt amongst property investors. And we've been very vocal about that. Concentrated debt in some of the rural industries and some of the dairy industry we've been very vocal about. And we've been talking very bluntly with the banks around their lending behaviours and making sure as best we can, and that will continue, around their commitment to responsible lending. Remember, banks don't end up wearing the end outcome of it. It's the person who borrowed from the bank. And probably one of the wisest words I've heard from one of the many wise staff members here is that a loan offer is not financial advice.
Hamish Rutherford from Stuff. Given that you say we're at a starting sweet spot in a business cycle, do you think business confidence in New Zealand is too low?
Personally, I'm surprised of how low business confidence is. How does that matter? I'm not sure. Generally, it's businesses' sense of their own activity that provides a better indicator of what they themselves will do. So they have got something else that's upsetting them, because their surveys, and correct me if I'm wrong there, but the surveys of businesses' own activity remain pretty positive. I deliberately use that word "should invest" actually in the front page of our statement. But should is based on we expect through our projection. But given the capacity constraints that are coming through, why wouldn't businesses be investing? Given the level of interest rates, given the state of the balance sheets across the business sector, it is an opportune time, as it is for the government.
So does that "should" constitute advice?
No, that constitutes an outcome of our projection. Based on our projections, they should be investing.
Hi, Lynn Greason from Banking Day and Newsroom. You seem to harden your approach to the banks. You were talking about having tough talks with the banks. Does that reflect that you were surprised by what came out of the Hayne Banking Royal Commission?
No, it doesn't. Well, surprise, yes. What I think this institution has been suffering from is a lack of open dialogue around what we have been doing for a long period of time. And instead we've let the banks and all commentators own that space and not us. We have been working very, very hard, and you've heard the squeaky wheels from our hard work come from those who are being worked hard around adequate capital, around the ability to have open bank resolutions, around how they are behaving with regard to their lending, and most importantly, the role of New Zealand directors. These are New Zealand licensed and registered institutions. They may be owned from offshore, the vast bulk of them, but they are here to do business in New Zealand for New Zealanders. And when they attest, they are attesting to New Zealand law and our regulatory behaviours, and we've been working with them for a long period of time. The Australian Royal Commission has thrown up all sorts of noise. What it's thrown up mostly is a lot of hiatus amongst the public and commentators, and what I've been saying is we understand, we know, we are doing our job, and we have upped that on this particular issue because culture is what we're trying to get at. So we're saying the culture of New Zealand banks have to be for New Zealand and consistent with our laws and expectations. Show us again how that is happening. Show us how it is different to what we're hearing from Australia. And we will be playing that out very clear and publicly. And I think, you know, a cultural check and if needed a cultural readjustment is extremely timely.
So does that mean you've shifted from your view that the culture of the banks here is infinitely better than in Australia?
No. What I'm saying is show us and show the public that. I can't sit here as a regulator and say, I'd love to tell you, but it's all tip-top secret. I've said, come and tell us. I've had Jenny Ruth claiming that, you know, a bank outed themselves many years ago. That's just wrong, you know, and I've told you that. And, you know, this bank has been involved for a long period of time in very tough negotiations with the banks. What the public hears is a confusion of banks getting confused that they operate in New Zealand. You operate in New Zealand banks. They get confused that you have a home and a host regulator. We choose to both accept what's been done, but we will have additional things to do. And they get confused that we need to balance soundness and efficiency. We are blessed with good banks, we're blessed with fantastic world-class banking services, but if a bank fails, they're not there anymore and we have to pick that up. So that's what we're working on. What you hear is complaints across all three levels, and so the directors need to work with their banks and their CEOs to make them understand you're in New Zealand.
Governor, your predecessors have made a habit of commenting on the currency in their opening statements.
Look what happened to them.
Yeah. And a couple of them did get involved in intervening in the market. What's your general view on intervention in the traffic light system?
I'm a big supporter of intervention and the traffic light system. I should be. I put it in this place when I was here as Deputy Governor 12 years ago. I'm pleased that it hasn't had to be used very often because that's the whole purpose of it.
And on the issue of monetary policy and fiscal policy working together, one of your scenarios is for a global crisis or change which would slow growth here. How much help would you expect or want from the government with a looser fiscal policy in conjunction with the looser monetary policy you talk about?
I think you've described what is actually happening. You know, the current and future planned settings for fiscal policy is expansionary. You know, they are adding to, again, about 0.5% of the GDP growth that we forecast ahead. It's both through government spending, government investment, and also through the transfer into households for consuming. So they are doing a positive leg. For them to respond instantly to, say, an unanticipated shock, that's much harder. You know, the lags are very long and highly politicised, being government. And so that's why monetary policy picks up most of that burden to the best of its extent, because we can operate independently.
Thank you for box D in the statement, which talks about the US dollar funding cost pressures for the banks. They haven't seemed to have passed on some of those increased pressures, and you say that it's one of the risks. I mean, how would you feel if they said, you know, okay, it's time we passed it on, we started putting up interest rates, and do you think there's a risk here that they could do even more of that and in effect, you know, blow a headwind against your monetary policy?
That is a risk, and that's why we put that in the box. And we have been, you know, interested in the fact that it hasn't been passed on as much, and we try our best to understand what the dynamics have been. What I would point out is that the banking sector is very competitive, and so being able to just simply pass on all costs, unfortunately, can't just happen like that. So, you know, the competition in the banking sector is a really key feature for us. That's not to say they won't pass it on, and if they do pass it on, we have higher interest rates, then we have more work to do than otherwise.
So does that mean if they do pass it on, you'd have to look at maybe cutting the OCR in a reaction to it?
I would say that at that point, a butterfly has flapped its wings and the world is different. We'd have to reassess what we're doing. Cool.
I think about a year ago there was a lot of fear that China could be the source of the next global financial downturn. How much do you think President Xi has got the shadow banking sector and debt levels under control?
Paul, that's a monstrous question. China still sits there as a concern for the global economy, given the debt positions they're in. The very positive thing about China is they have more levers, more instruments than targets, and they can control a lot of this from HQ. So, you know, the problems are well identified, and they seem highly committed to working through these problems. But that is still a concern, as Jeff mentioned before.
Yeah, I'll just add that absolutely the overall debt levels and the past history of financing's worried us. There are some good indications that they made some progress. Some of the shadow banking sector and sort of financing of local government and other entities has slowed quite considerably. So we've got some signs that they're trying to get hold of that and reducing the worst of the low quality lending risks. But I wouldn't say they've solved it. It's high up on our watch list.
Wonderful. Just the last question.
Okay. The New Zealand government, the newish government, how much of effect have they had for your job? You mentioned 0.5% bump in growth, but increased education spending, the Amazon tax, increased diplomatic spending, all these things, how's it affecting your job?
It's all baked into this wonderful document, the Monetary Policy Statement. So for example, what is it, the free tertiary education first year, I said that right? You know, that is one of the reasons why headline CPI dropped low. It's going to fall out though. That's one of the reasons why the CPI annual will pop up again. So, you know, these things always have to be taken on. At the big level, they are a net positive influence on spending, on capacity pressure in the economy on the way through. Okay. Are we happy to call it an end? Jenny, is this going to be a brilliant, insightful question? Have you?
The first one's the easy one. Is the results of the three banks that reported in the last couple of weeks have all showed a big increase in net interest margin, but you're worrying about funding pressures.
That's a statement.
Well, that's the question about that. You know, why they've shown a big drop, and yet you're worrying about funding pressures.
They've shown a big drop in
net interest. A big increase in net interest.
Yeah, they've been very profitable. So I imagine competition pressures will rise.
The other question is about ANZ's problem with a loan calculator, and I wondered whether you had any observations about the more than 3 years it's taken to fix it. It still isn't fixed. And the fact that they're not getting around to starting to tell customers about this until mid-June, and it'll take them 4 months to inform all those customers.
I'm guessing that something called market discipline will help work on that, because you've just told the nation's press that that is the case. And so their customers may not have to wait till June to be told by ANZ that that is the case, if it is the case. So that's why it's not just regulatory discipline, it's self-discipline. What are the directors doing about that? And it's market discipline. What are the competitors doing about that? What's the public doing about that? What is the reporting journalists? What are the reporting journalists doing about that? If it has to be us who runs around and fixes every problem for banks, then we own all the risk, and we're not rewarded for that. Okay, I just want to make one apology and one thanks. I want to make apology to anyone who understands sign language for my very poor sign language. I just practiced that for the first time, and I promise to improve. And other than that, I want to say, me taki ma'ata, thank you very much. All the best.